Hey, what's going on, everybody? Real Estate Coffee Talk number 6. All right, so everybody, the point of this podcast is to educate professionals within the industry as well as consumers on all aspects of the real estate market. All right, so Evan McCarthy, once again, Sam Wesoloski, beautiful people. Evan, I just hope Evan doesn't hate me. Right when we started this, we got into it, but we love each other.
Lovers quarrel.
And this is take 2 because we didn't hit
2.
record. So it's exciting stuff. But
who's
it's cool.
Nonetheless,
in charge of
yeah, right.
Dad.
Nonetheless, we're going to talk about interest rates today, right?
Everybody's favorite.
Yeah, and right now it's a really weird time in the market. We're in a rising rate environment, which we haven't seen in quite a while, especially within the last 2 years. Rates were at a super all-time low. They're still at an all-time low. We'll talk about that in a minute. But it's a weird environment right now because it's still super competitive in the housing market, and we're in a rising rate environment. So this is the perfect time, I think, that we could talk about this subject on what interest rates are, where they come from, because everybody loves interest rates, right? They want the lowest one, but nobody really understands where they come from, how they come into play, and
Or even what it is.
Yeah,
What
right.
What influences them?
Right. So, hopefully the point of this podcast, this specific episode, is just to cover all of that and just really educate everybody on, where interest rates are, where they come from, and everything you need to know when it comes time to actually use that information.
Yeah, for sure. Evan, how you been dealing with this since everything's been blowing up here?
See, I honestly don't get the question that often about rates.
It does come, though.
It
sometimes.
does.
I've even been with you sometimes at open houses.
Yep.
Yeah, because everybody's been spoiled.
Yeah,
That's why.
So and that's the thing. Kind of like Sam just mentioned. I emphasize look, yes, even though they are higher than they were even 4 months ago, significantly.
Yeah, even in the past
Yeah,
week.
right.
Okay, well,
Week,
exactly. Yeah. So even though they've gone up drastically and over since where they were 2 years ago to where they are now, and people are like, oh, well, why are the rates higher? And I still take the time to explain to them, look, where are we currently?
Well, there's different criteria,
Depends.
but
Well,
yeah.
so what would you say is just a ballpark?
high fours,
Yeah,
low
mid to high
fives.
fours.
Okay, so for example, I use that and I say, look, here's where the rates currently are. My parents purchased their house in 2005. They're sitting at a 6.5% interest rate. That was low at the time.
Yeah.
And that was low at the time. And yes, I know you're looking at me thinking, why did they not refinance? I've been asking that question.
No, not at all. No.
I'm thinking
I
that.
am.
He's thinking that. We have this conversation all the time. But, that's the thing. Those were low for the time, right?
Yeah.
Look at us now. We're a full point and a half under that.
Yeah, but it's high, right?
Yeah, exactly. But it's still high. Mm-hmm. Yep. So that's what I try to emphasize. When I get that question, I say, look, yes, rates are higher in retrospect to where they were a year ago, 2 years ago, but they're still low.
And I had a conversation today with another real estate agent, and we were talking about this client that's pre-approved right now, and he was like, yeah, just keep explaining to them that the values and the prices are going up, and so are rates, and pretty soon they're going to be priced out of this market if they don't do something soon. And now I know the whole the rates, that's not something that's really in your, I guess, field. That's more of our side. Well, it's definitely our side, but it's definitely a question that you get asked. So I think that this podcast could actually help agents too when they're informing their clients. Obviously it's the mortgage planner's job at the end of the day, but having that information could be helpful as well.
Right, and we've talked about this on other episodes too, whereas I like to have a general knowledge of everything that's involved with what I do, but at the end of the day, I prefer to point them in the direction of the appropriate professional, whether it's tax, legal, rates, any type of construction or inspection stuff, just so that way I'm not on the hook if I give you bad information, right?
Yeah.
That way I leave it in the hands of the professional who deals with it on a daily basis. So
Yeah, for sure. Well, at the end of the day, too, it doesn't matter if you're pointing them in that direction. You should thoroughly still be involved because you're the front line of defense. You're the boots on the ground.
Yeah.
So, with us, I don't know how other lenders work, but, we include our agents in on the actual mortgage coach analysis report because we're finding just because of the extreme volatility, we need to make sure that the agents are informed so that they can help, kind of step in, if things get out of hand, if they know exactly where the rates were last week, or you hear any kind of chatter on the internet or whatever it may be, they can reach out to us knowing that that's a red flag, right? So we want to keep everybody informed. Yeah. In regards to rates being at an all-time low, on the rise, they're still at an all-time low, like extremely low. Yeah. Like the long-term mortgage average since 1971 has been 8%.
Right.
So
that's double.
Yeah.
Where we are now.
Pretty close.
Yeah. And like you mentioned though, I mean, being involved is definitely a part of the job. And just from being around you two all the time, I mean, I pick up things about rates and where they come from, which we'll talk on. But the stuff I know now, if you would have asked me a year ago, I wouldn't have known it. I mean, you tell me stuff all the time, and I'm like, I didn't know that.
Yeah,
so
definitely. It's just, going back to what you said, Dustin, it's important for everybody to be on the same page, right? It's important for definitely the lender and the real estate agent to be on the same page. That way that, the process is stressful for their client to begin with, right? When everybody's not on the same page, it makes it 10 times worse. So it's super important that everybody's on the same page. And I know that's something we try to do to help the situation. But yeah, let's talk about, we're staying on the topic of interest rates. Let's talk about what happened in the last 2 years. Obviously, we had a pandemic, changed a lot of things, not only in our industry, but, in the economy in general. Dustin, you tell me the story all the time about how you were looking at the pricing desk and stuff kind of went crazy. Just kind of, can you give everybody some background on, what really went down when we went through the shutdown with the bond market and MBSs, and just kind of go from there?
Yeah. So I remember I was sitting at my desk, and everybody was like staying tuned, like, they're going to shut the country down. They're going to shut the country down. And I'm like, okay. And what happens? Lo and behold, they shut the country down.
Right.
So immediately when they made that announcement, our entire pricing desk closed. Okay, got the email. Pricing desk has been closed until further notice. A couple hours roll by. They open it up. It's you can't lock a rate. You could not lock anything. So they opened it back up. Right. They offered it, but there was a major sell-off in the stock and bond market. So everybody got out, and then poof, you just saw rates shoot up. That was it.
Yeah, and for everybody who's listening and doesn't understand, when the pricing desk closes, that's when something drastically changes in the market. And
either good or bad.
Yeah, good or bad, and they need to manually adjust it. So that just goes to show that it was a big change. A lot of change happened.
It was huge. It was huge. I mean, non-QM lenders, they shut their doors. Yeah. Like Angel Oak.
That's crazy.
Angel Oak, one of the largest non-qualified mortgage lenders in the U.S. And by the way, non-qualified, I hate that word. I look at it as an alternative mortgage.
It's a compliant way to say it.
Yeah, a compliant way, right? But at the end of the day, pretty much 100% of them shut their doors.
Right.
And if it wasn't for Freddie Mac coming in, non-qualified mortgage lenders, or private equity groups wouldn't have made a comeback. But the thing is we need them, and they were making such a strong lead in the market, and then poof, it was just all destroyed in less than 24 hours. And thank goodness they're coming back, because there's a lot of consumers out there that need the alternative mortgage programs.
Yeah, definitely. And obviously there was investors in the bond market. They pulled out. When a bunch of investors pull out, what happens? It's not as competitive anymore, and rates go up, right? That's what happened. So the pandemic stayed, but rates dropped, right? So that would mean there's more competition in the bond market. But if all the investors pulled out, why would rates drop?
Well, all right. So what happened was you had a bunch of investors pull out. So there's something very similar happened. So in 2008, when we had our housing crash, the stock market crash, right? Fannie Mae and Freddie Mac, which if nobody knows, they're government-sponsored enterprises or entities, right? They're essentially the ones that purchase a majority of mortgage-backed securities. So if you have a home, they're going to buy that loan off of us, right? They're going to package it up into a security, which is like a bond, okay? And they're going to sell it to investors, right? Investors, that's how they make their money, right? You have your private equity firms like your non-qualified mortgages or something that doesn't conform. Right. But basically, when the crash happened, we, the federal government or taxpayers, had to bail them out. Yep. And what they basically stated was, all right, we'll bail you out, but now you're under conservatorship, right? So Fannie Mae and Freddie Mac were actually publicly traded up until the housing crash, right? So now they're under conservatorship. And then basically what happened was the federal government, the Federal Reserve, started purchasing mortgage-backed securities, right?
Yep.
And they own about 2.9 trillion, which they own more than any other investor in the U.S. And they just kept buying them, and that was their way of stimulating the market, right? So when they stimulated the market, well, what did it do? It caused rates to kind of dip down. It's the same thing that we're seeing right now with the pandemic, except they went to all-time lows because I don't ever remember seeing the country on lockdown, ever. Right. So a drastic change needed to take place, and that's exactly what happened.
Yeah, and the way I explained to everybody is, what they did is they simulated competition. That's what they did. Is they simulated competition by buying up these mortgage-backed securities to stimulate the economy. Otherwise, it would have been very bad.
And it enticed people to come into the market then,
and start buying and selling and refinancing.
Yeah, exactly. And also it enticed people that may have been at a little bit higher rates. I mean, how long was the refi boom? I mean, you guys
about 2 years.
Yeah. I mean, I know you guys were pumping those out at the same numbers that you were doing purchases, if not even maybe higher.
Yeah, a lot of people refinanced.
Helping a lot of families.
Absolutely. And that's the thing. I mean, even if it was from 5% down to what 3? Yeah. I mean, that still makes a difference in how much they're able to save every month, how much their monthly payment is. I mean, people were able to benefit greatly off of those low rates, and like you said, as they do that, they're putting more money back into the economy.
Definitely. So I mean, and that helped a lot of people. The thing is, though, the whole point was to stimulate the economy, right? Help it kind of revive itself, get itself back together, get unemployment numbers back down. And that's kind of where we're starting to see today, right? The economy's getting better. I haven't even heard about COVID. I know we were talking about this.
Nope.
Airplanes don't require masks anymore.
I don't know if that's in full effect, but
even New York, they got rid of their mandate. You know why? Because Kyrie can play again. I just read that.
There you go.
Yeah. So Kyrie,
he can play again. He's in New York, so that says enough.
And that's not totally relevant, but to be truthfully honest with you, it seems like it's kind of gone now. The economy is picking itself back up. Unemployment numbers are looking
lowest
really good.
Jobless claims since 1969. Yep. It's huge.
It came out on Thursday, right?
Wednesday or Thursday. Yeah.
So this is why we're starting to see the Fed start to taper off, right? And they're starting to sell off those MBSs that they bought up to stimulate the economy, and that's why we're seeing the raise in rates.
Well, yeah, first, everybody has to have a correct understanding what they mean by balance sheet, okay? So essentially what the Federal Reserve was doing is they were purchasing trillions of dollars of mortgage-backed securities, right? They're purchasing a few billion a day, and they own, once again, almost $3 trillion, right? So what they were doing with all of the revenue was they were just reinvesting it back in MBSs, right? Mm-hmm. And now we're looking at high inflation, almost 8%, right? So our housing market is our way of hedging against, inflation, right? Sure. So what the Fed said was, okay, we have high inflation rates. We have the most solid job market we probably had since the 1970s, right? We want to basically combat this, and what we're going to do is we're going to raise interest rates. And it was the first time that we have seen rates raised since 2018, and we're talking short-term rates. And then they stated that they're going to stop reinvesting those dividends, okay, or those payments back in, and they're going to stop buying mortgage-backed securities. So they're done. It's kind of like, go on, we're done. We're done holding your hand. Go play.
Helping, right?
Exactly.
And I'm really glad you brought that up because I get this all the time. I'm sure you do. Okay. The government's raising rates. I'm really nervous. I don't know if I want to buy anymore. They're going to raise rates for 7 times this year. That does not directly it has an effect, but does not mean they're raising mortgage rates. Just because they raise rates a quarter, it was a quarter they raised it.
Yeah, quarter of a percent.
Quarter of a percent. Yeah. Okay, that does not mean mortgage rates go up a quarter of a percent.
No,
it's
not at all.
a direct effect. And I think that's what a lot of people think. Just from the surface, that's what people think. So I think I'm really glad you brought that up because that's super important to notate. That's not what that means, right? It has to do with the balance sheet. And,
I mean, there's other factors too, but you know what? It's our fault as professionals that means that we're not educating the general public like we should, being that this is the largest emotional financial decision you're ever going to make. Mm-hmm. But it also gives us an opportunity to kind of pick up the pieces that other people allow to fall, right? And when you look at interest rates, everybody, listen, they've tracked them since 1971. Freddie Mac, okay? All right? It's been at 8% at the average. If you want to talk about high interest rates, from the 70s to the 80s was the last time that we saw heavy inflation, and it reached 16.63% in 1981, right? What did they do? They had to raise rates, right? But just think about it. $200,000 mortgage at 16.5% is the payment's almost $2,800 compared to right now, $1,300. So everybody get away from that. It's good that rates are going up. We need this. That means that things are looking bright. Yes, we're combating inflation, but we have a strong job market and they want to protect price stability. So be happy, okay? Because that means that your investment is safer.
Yeah. Yeah. When that starts to happen, 100%. It means they're comfortable with where the economy is right now. They're comfortable with the direction it's moving. And if the Fed's comfortable with it, then why shouldn't you be?
I mean, they kind of cost it a little bit because they did pump $4 trillion, I believe, into the economy. And the whole...
Are you talking the inflation?
Yeah. Well, and here's the problem, everybody. Inflation, remember, okay, our wages need to keep up with the price of goods, right?
Yeah.
So you want the prices to stop, flying off the shelf and raising. Okay, we got to stop it or combat it to an extent.
Yeah. Well, and you just mentioned that. I think 2020 or 2021, I think it was like over 50% of all the money in circulation was printed in that year.
Yeah.
And that was, trying to stimulate the economy via unemployment, any other type of...
Oh, they're incentivizing people to sit home. They're incentivizing people to sit home.
And that's the thing. Crazy. I mean, that money, although it might have been free money, like stimulus checks and stuff, all they were printing, I mean, we're going to be the ones to pay for it. I mean, I wouldn't be surprised if there's taxes, taxes that are put in place years down the road that are.
Oh yeah, 100%. The future generation. My daughter, my daughter, she's going to be paying for it. I already know.
Yeah.
How do you get away of $4 trillion of debt? When our GDP yearly doesn't even meet close to it, right? So
I mean, the most simplest way to look at it, and I like using this analogy, is like, okay, when you go to the doctor, or when you hurt yourself, right? You need to have surgery. You have your surgery that fixes the problem, and then you need to go through recovery. That's kind of what just happened. We hurt ourselves because of COVID. Well, we didn't hurt ourselves, but we got hurt because of COVID. We went through surgery, manual fixing, and now we're just recovering from it. And we're seeing the effects, and this is just a part of the process. So that's a way I like to kind of put it in the most simplest way possible on what we've been going through. So, okay, so that's what happened in the last 2 years, right? That's how we got to where we are. Let's talk about where these interest rates actually come from. So, it's obviously from the bond market at this point. You probably figured that out. But, where does Chase Bank, where does Rocket Mortgage, where do these companies pull their rates from? Do they just wake up one day and they're like, I want to charge 5% interest rates? I wake up one day, I want to charge 2% interest rates. Is that what it is? I know it's not. That's what some people think. And what we say all the time is we're not going to sit here and lie to you and tell you all banks are the same and all mortgage companies are. No, they're not. There's margins built in. It's a for-profit business, but they don't make the rates, right? And that's what I really want to talk about is where do these rates come from?
Yeah. No, so I mean the rates, so they derive from what we call as a UMBS, Uniform Mortgage-Backed Security, and it used to be just MBSs, but UMBS is when Fannie Mae, Freddie Mac, they combine with their securities, right? Yeah. So your money, naturally it comes from us, right? But it's derived from actually private investors, right? If you have a 401k, if you have a sovereign wealth fund, IRA, whatever it is, if you see an MBS in there, okay, which is a long-term bond, right, which is the reason why it has more volatility, you're investing into somebody's mortgage just on a very small platform, right? So when we're also looking at it too, is it comes from private equity firms, right? So private people that invest into non-traditional mortgages. So that is simply put, that's exactly what happens. So what happens is we will facilitate that transaction, right? We have a warehouse line that we pay interest on. We will write the loan, okay? And then what will happen is we'll write X amount, and then what will happen is Fannie Mae and Freddie Mac will go, hey, we want X amount of trillions of dollars, right? Can you give us, 1,000 loans at, $100,000 a piece,
right?
And essentially what they'll do is they'll buy them from us, so we can free up liquidity, so we can help more people. This is why people don't hold loans anymore, guys, unless it's like a small credit union, and they might even get rid of it too, because remember they only have so much capital. And then what happens is Fannie Mae and Freddie Mac will take that and they will offer it to investors, right? So where the rate's going to come from, it fluctuates just like the stock market, right? It is what an investor is willing to pay on that particular day, right? And people have to understand that bonds, remember, when you write a note, yesterday, right, the cost of the dollar, well, inflation at just average of 2% over the past 15 years, that's going to rise, right? So that price of that bond doesn't change, right? So you either have to sell it at what we call, you're either buying it at face value or you're giving it at a discount. Remember, that bond stays the same. If you keep it through maturity, right? But the problem is people don't want to hold that debt for that period of time, right? This is why you see things buy and sell, and this is why price fluctuation comes into play. So to answer your question, no, we don't create it. Now, we have margins, right? And every banking institution controls their margins. I can tell you this right now, ours are extremely small because if you want to compete in this market, especially with these big tech companies, 100%. Sam, you say it the best. You go, listen, we're not a household name like Rocket Mortgage or Loan Depot, but what we do is we cut our margins down to nothing because we want to be able to be competitive.
We have to. That's what I tell everybody.
Yes.
We're not a household name. We're not Rocket Mortgage. We're not Chase Bank. So if we didn't cut our margins super slim, we would have no customers. And so we have to do that because
rightfully so, by the way.
Yeah. Rocket Mortgage, Chase Bank, those big names, they're going to have customers forever, no matter how big their margins are. People are always going to go to them because they're Rocket Mortgage and Chase Bank and Loan Depot. They're
household
huge
names.
companies.
Right. And even look at the Super Bowl. Rocket Mortgage had a Super Bowl commercial.
What was that, like over $2 billion, I think they invest into marketing?
It wouldn't surprise me. But when you're a huge company
Something
like that,
like
you're
that.
able to have your name in front of everybody. If you go to, I'm not going to guarantee this, but if you go up to any person, you ask them to name a mortgage company.
Yeah, that's probably the first one.
The first one that usually would pop into mind is Rocket Mortgage.
But remember, everybody that we don't sit there and really control. And every lender, every lender for the most part, they want to be competitive. Okay.
Yeah.
I don't think anybody's intentionally going out there to overcharge, but I will tell you that some people will play with that string and see how much they can pull it until there's resistance, right? So they'll try to get a little bit here and there, but we don't control them. And every single day they move up to 20 times a day. Because remember, who controls your rates are going to be private equity investors, and depending on how many want to sell and buy on that day, depending on what their emotions are. That's why I always say the stock and bond market. Emotion. That's all it is. Exactly. Legalized emotional gambling.
Exactly. And the other thing is stock market, and this is how I understood it, or what made me understand it better. Stock market, you trade equity, right? Bond market, you trade debt.
Correct.
So could you imagine going up to a stockbroker and you're like, I want to buy Microsoft, and he's like, okay, one share of Microsoft, I don't know how much it is, let's say $900, and you're like, no, I want it for $700. He's going to be like, what are you talking about? I can't give it. That's what it costs.
But he might go, we'll deal with a little bit with you, but that price is already determined when they open.
That's what I'm saying.
Right,
so you can't go to a stockbroker and be like, I want this stock for this price. He's going to be like, no, I don't make up this price.
Exactly.
I go to the market.
Exactly.
It's the same way.
Right.
Stock market, bond market, just debt. Stock market's equity. That's all it is. So, when people come to us and they're like, okay, I want the lowest rate. I want this rate. It's just, okay, we'll get you the lowest rate that's available. There's so many different investors that we work with, and we can go into that a little bit later. But I think that's the best way to explain it. Is imagine going to a stockbroker and saying, I want this for this price. They're going to be like, I can't. It's the same thing for us.
Absolutely. And listen, do you think that we don't want to help you? I can tell you right now, I'd much rather do a loan for free. Okay. Like just an example, we had a client, we cut all our upfront costs, right? I'd much rather do a loan for free and gain a client for life than make money on a client and never deal with them again.
Yeah.
Right. So everybody should be genuine, but it's a fault on our end. And you have a lot of inexperienced, financially illiterate loan officers that put a bad name and they use that rate game. I don't know why the first thing that you look at when you type in rate in Google, go ahead, put mortgage rate in Google. First person, Quicken Loans. They're tech companies, right? It's marketing. It's how people captivate your attention. They capture it. Yeah. They talk about rate, making it the most important thing, and it's not. And we're going to get into that next too.
Yeah. No, it's they pay for that, by the way. They pay for that first search result, obviously.
A lot of money too.
Oh man. Cool. Well, I think we covered a lot in this side of it. We really went into where and tell me, Evan, if we did a good job of explaining where rates come from, because you're on the outside. It's easy for me to try and say, this is a good way of explaining it, but I really don't know because I see it from the back end.
Yeah. I think you guys did a really good job explaining it because, like you said, it's with the analogy, I think, of the stockbroker. I think that right there kind of sets the expectation with the consumer because, just as you know it, I know it. Everybody's looking for the best deal, and I know they probably try to haggle you guys on rates, and it's, look, this is what it is.
I mean, they'll ask us. Yeah, they can haggle all I want, but I'll go back to that pricing desk every hour and I'll be like, it's not changed. It's not changed. It's not changed. It may change later, but it hasn't changed yet.
In this time frame now, hey, it's worse. Are you glad you waited?
Right, exactly. So it's just giving actionable and actionable education that they can use
on how it works.
Exactly, and how it works. Because if you understand how it works, then there's no fear, and I think that's a big problem is fear.
Awesome. Yeah, no, definitely. So I think that's going to conclude the first half. We'll be back talking about different investors, different banks, brokers, how that works with the bond market, and then I think we want to touch a little bit more on actually servicing the loan, and that doesn't mean who owns the loan, because I feel like that's important too. So
yeah, exactly.
We'll be back on part 2.
All right, what's going on, everybody? We are back. All right, so finished off, kind of why rates are still at an all-time low, what affects them, what influences them,
where they come from.
Yeah, where they come from. Now we want to talk a little bit about the infamous, why is the rate on my pre-approval so high, or why is that rate on my pre-approval different from what I'm seeing today, and why shopping for rates means absolutely nothing.
Yeah.
All right.
Yeah, I mean, let's give a little insight, okay? So to put anybody in our shoes, when you go to get a pre-approval and your mortgage planner is looking at what you can qualify for, they're going to look at something called a debt-to-income ratio, which we looked at before. And what goes into your debt-to-income ratio is your perspective or your future housing payment that you would take out with this mortgage. Now, you have to plug in an interest rate with that to get something, right, to work with. And normally what you'll do is you'll go with whatever market value is on that day and whatever the par rate is. And we'll explain a little bit about what par rate is and things like that. But it's just based off of this day, this is a rough rate just so we can get an idea as to what your debt-to-income ratio is. And that's what goes on your pre-approval, if there's a rate that goes on your pre-approval at all. So is that the rate you're going to get? No. Is it going to be higher? Maybe. Is it going to be lower? Maybe. Is it going to be the same? It could be. It's not always guaranteed, though. But just to give you some background, that's what we do every single time we get a pre-approval, and that's why that rate goes on there.
Absolutely. Yeah. And here's why anybody would have this conversation is because the mortgage planner is not thoroughly educating them and explaining, because like in our consultations, what we do is we actually try to get the agent involved as well. Like we have our one-on-one with our client and then the agent. And what we're doing is we're giving them a crash course on the bond market, right? We're giving them a crash course on why things move, where they're at, why this is probably not going to be the same. But we also are going to give you an opportunity to pick your interest rate. We're going to give you typically up to 4 different strategies. And we're going to look at how long it takes, how long you're going to be in the house to determine what interest rate's going to be best, right?
Yep.
But the fact is everybody has to understand that they move, right? And if you're in a position, if you're a mortgage planner, and you're encouraging your clients to sign with you because you have the lowest rates, you're doing a disservice.
Yeah.
So, yeah.
Yeah. I mean, let's just go into that. So like we said in the very beginning, big investment when you buy a house, whether if it's your second time, third time, fifth, 10th time, right? It's a big investment. And you want to make sure that the strategies you choose with on the mortgage align with everything else that's going on in your life. How long you're going to be in the house, how much assets you have available, basically everything. You want to make sure it aligns with what strategies you choose to go with the mortgage, align with everything that is going on in your life. So when it comes time you go under contract, it's time to lock your interest rate in, because that's the biggest thing. And I think we should touch on the lock ahead and should I lock now after this, because that's another thing I've been hearing. But when it comes time to lock your interest rate in, you're under contract. Like you said, we're going to give you options. We're going to say, here's what the par rate is. And for anybody who doesn't know, the par rate is the free rate. So this is on this day for your criteria with your credit score, your debt to income ratio. This is what our investors, the best pricing investor, is willing to give you on this particular day for your criteria for absolutely no cost.
And that's different for everybody.
Yeah, it's based on your criteria.
100%.
So credit score, debt to income ratio, what kind of program, your loan to value, all that stuff.
Yeah, I just wanted to bring that up just because I know you've told me in the past that you've had people without
just want to know what the par rate is.
Yeah, they want to just curiosity call, like, hey, what's the par rate? And I know you told me. I know you told me like, well, I can't because it's different for everybody. I don't know what your credit is. I don't know what your debt to income is.
Easiest way to put it is it's like you walking into a doctor's office, saying that your stomach hurts, saying, hey, doctor, I've got 15 minutes. My stomach hurts. Please diagnose me. What is the doctor going to do? He's going to do a thorough examination. And this might sound elementary, but that's the truth. Go find me a doctor that doesn't do an examination before he diagnoses you. Right? So it's a diagnosis based on, and your complications maybe, or your challenges might be, how long am I going to stay in the property for? What are my monthly budget levels? What do I want to bring to closing? How is this going to correlate with retirement and my kids' college funds? Things of that nature.
Yeah. And I hear a lot of people think, because, that's truthfully.
A really good point, Evan. I'm sorry, I didn't mean to cut you off. Really good point.
That's truthfully what happens, right? Is you need to have a full understanding of their situation to really give them an accurate answer. And I think sometimes people think that's just BS that we say because we're salesmen, which you shouldn't be if you're in the industry. But that's what people think. It's just BS that we say just to get you to let us pull credit and things like that. But in reality, what I do is I literally show my clients, I go, look, this is the pricing engine. This is what I see. These are all of our investors. I type in your credit score. I type in your debt to income ratio. I type in everything. This is what it looks like. So I'm not blowing smoke.
Well, and I think that people kind of have that notion is because when you see TV commercials, you see news ads, you see any type of advertisement, major corporations are slapping a rate on it.
It's marketing. It's marketing. It's the easiest way to captivate anybody's attention.
Yep. And their thought is, okay, well, that's the rate. And then when they call you, well,
what's your rate?
So-and-so, what's your rate? And
Well, it's our own fault. It's our own fault. In our industry, it's our fault because that's how we market because it's
also
the
the
easiest
consumer's
path
fault,
of path of the least resistance. No,
Because in those, there's fine print. You mentioned it before we started recording again, and that's the thing. Even though that's the rate they're showing you, if you read the fine print, exactly.
There's always a cost to everything, okay? Everybody, nobody has a magic wand, okay? We don't.
100%.
It's not our money. Well, it is, but we're reimbursed immediately afterwards. Unless you're a servicer. And honestly, if you're servicing a loan, like we service a small percentage, but the investors the servicers don't make money for like 3 years because they have to pay a premium up front, a right to collect those payments for the bond investors.
It's still not your money. Even if you're servicing it, you're just collecting the payments for the investor.
Yeah, we're a bill collector.
But anyways, so what I want to get back to is what I was saying before. Okay, when we have this initial consultation, okay, here's what the par rate is. Here's what a point buy down. Here's a 1.5. Here's 2 points. Now, the best way I can describe points is no, they're not fees, and not every bank has points, and not every bank doesn't have points. It's the best way to describe it is points are prepaid interest. Now, depending on how long you're going to be in the property, sometimes it makes sense to pay those points because you're going to save enough money on interest to overcome what you're going to pay up front. Some people don't have access to extra money to put down on or to buy points. But that's what we do. We have the conversation. We go, okay, here's your situation. Here's 10 years down the road. Here's how much interest you're going to pay in this strategy and this strategy. Which one do you want to go with? This is what I would do, but which one do you want to go with? So no, you're not required to pay points. And that's exactly how it works. So, when you just, okay, what's your rate? Here's my rate on a pre-approval. That's what we do. And like we said, you let them pick the rate, right? What strategy do you want to go with? What's going to align best with your goals moving forward?
And with you mentioning points, and you said not everybody has the money. Well, that's the beauty of real estate contracts. You're able to ask the seller, hey, can you contribute X amount of dollars towards whether it's closing costs?
We need to get back to that kind of market.
Points and or prepaids. I mean, my last 3 deals I've gotten.
Just by saying that, I could already tell Dustin got excited. The seller buy down. I guess I saw his eyes go.
Listen, I love strategies. I'm a puzzle guy, man. I mean, give me the puzzle. Let me put it together.
My last 3 buyers, every single one of them's gotten.
That's because you're good. You're good at what you do, but a majority, I don't see.
Way to show off, bro.
Yeah, seriously. Yeah, like seriously. Oh, there it is. All right, so make sure you got that. Okay, that needs to be in the clip. Okay, so seriously, you're getting a one-off on that one.
Oh Lord, but no, you guys talk about strategies. That's one thing. Hey, you don't have the money, but you want to get this lower rate.
Well,
seller.
Rate is everything, but people need to understand that rate's just a factor. It's not a benefit, right? So what mortgage program might be good for one person might not be good for another. If you're staying in your house for 3 years, compared to 15, we have to look at the resale value based on the hypothetical appreciation, and conservative is going to be around 4%. It's been 3.71 over the past 30 years. Right. But we're going to look at that. We're going to look at where your balance is going to be, and then we can make comparison on interest rates, right? So the lowest rate doesn't mean the best program because remember, a mortgage has to work for you. You don't work for the mortgage. So if you want to, exactly. And prepaid interest, okay. In theory, over a long period of time, yes, it makes sense to do that in particular cases, but we also have to factor in, what do I want to bring to closing?
Right.
What
What am I prepared for? Right? Or do I have an opportunity cost to stick that extra money that I would have paid points into an interest-bearing account? Right. So those are the strategies that we're really thoroughly looking at.
You gotta look at everything, not just here's the lowest rate. How does that sound? No, it should be a lot more than that.
Well, just as the other week we talked about, each loan program has its perks and disadvantages for people's situations. Same goes for the rate.
100%.
There's going to be benefits and there's going to be cons to each one. You just have to find which works best with. I mean, you talk about all the time when you meet with your clients. You need to figure out what their goals are, long term, short term, what it is. Each rate is going to have different outcome for those goals, and there's going to be one that fits best.
Yep,
exactly.
So,
yeah, no, and it's something you brought up when you're going through the strategies. It's okay. Here's what your net worth is going to be in 5 years, 10 years, however long you plan to be in this house. But you also can see, based on appreciation, here's what you're going to net. So when it's time to move up in 5 years, when you have 3 kids or whatever your situation is, here's what you're going to net. Here's what you can expect closely to net. This interest rate, here's what you can expect to net at this interest rate. And that's all people care about, right? Is the end.
The bottom dollar. Well, they should, but they don't, because you have the media.
Well, they don't
think programming us.
Right. And they don't think they think that they care about the interest rates, but it's really not.
Until they see the numbers.
What the bottom dollar is. Exactly. That's what they care about.
I challenge anybody. Ask me for a rate, okay? And I challenge you, okay, that you probably, depending on your time length, you're not going to get the lowest rate. You're going to pick a program that fits your needs.
Yeah. So, yeah, after you see the bottom line and the numbers.
Correct.
Well, and here's what I'll say about rates too. People always need housing. So to an extent, you just, like you said, you have to find what works best. The rate.
Speaking of housing,
at the end of the day, it doesn't. It matters, but at the same time, it doesn't, because you're going to have to buy a house, and buying is a better alternative than renting. So.
Especially now.
At the end of the day, rate doesn't matter.
Well, your interest rate with renting is 100%.
Well, not only that, have you saw the year-over-year increase? Okay, so it was, I think 4% coming from last year, and then now it's 11, almost 12% increase in rent. So if you don't like 5%, okay, well then you're going to like 0 return on your money, and you want to pay an increase of 11% a year. And it's only going to get worse, guys, because remember, limited inventory, 70 to 90 million people waiting to buy, and these investors are just going to eat it up. And the demand for rent is probably even the same or more for housing.
I think rent is increasing at a higher rate than
100%.
So ownership. And here's the thing too. Like you kind of just brought that up, and you mentioned it too. Rent, you're paying 100% interest. Yep. Okay. Would you rather pay rent, put it in the landlord's pocket, or would you rather pay your mortgage at, let's just say, an outrageous number? You're paying 20% interest, which I don't, unless something goes really wrong, I don't think that's going to happen. But okay, 20% interest on that loan, you're building equity. You're putting. I think you've talked about it as a long-term
forced savings account.
Yeah, a forced savings account.
It is.
You're building equity. You're putting that money back in your own pocket.
Well, here's the thing. The forced savings account part of it, that aspect is, I'm borrowing money from you, okay? I promise to pay it back, and a portion of that I promise to pay back. I'm building, because my payment never changes. It's an AM schedule, right? Your payment never changes. Your loan amount changes every month. It reduces, and you're only paying interest on that reduced loan amount every single month. And your payment stays the same. This is why more gets allocated towards principal, right? Yep. That's your forced savings account. But your true growth, your true generational wealth,
it's the appreciation.
Exactly, which you have no appreciation with renting.
The thing before in my past life, before I got into the mortgages, something that really disgusted me was when I saw how much investors make on rentals. It's a lot of money, more than you would think. It's bad.
Yeah.
It's good for them because they're smart, right? They're smart.
Well,
putting their money in real estate. That's a great investment.
This is why you diversify your portfolio.
Exactly.
Guys.
It's just, okay, you take out a mortgage, you have somebody pay it for you every single month, and then year over year you're making 4% on your house. And so when you sell it, you're not only going to have somebody who just paid for your house for the last 30 years or 15 or whatever it is, and then you get to make 4% on your investment year over year over year.
If we didn't have the housing crisis, it'd be even more than that. I mean, we took a 30% dip nationwide. Imagine if we didn't do that. Okay, so we're probably, and what was it, 18% last year, wasn't it?
Last year values increased at 18%.
18%.
But here's what I will say about the housing stuff that happened in 2008. I mean, that's when a big majority of investors, people that were smart, that still had money, they didn't lose all of it, whether it was in housing already.
If they diversified, but they hedged against the housing market.
They were able to scoop up all this housing. I mean, now there's
there's
investors that have hundreds of units, hundreds of doors. If let's at 100 doors, let's say each one's valued at $100,000. Okay, that's $18,000 that they made last year, just in appreciation.
Yeah.
Times 100.
No, not bad.
Not bad at all.
Yeah, it's pretty good.
Yeah.
If you got the capital, I mean, you can do it. I mean, there's other ways too. You can invest into real estate without actually buying it.
REITs.
There you go. I was just about to talk about it. So yeah, Tony Robbins, I was watching his like 7 money ways or 7 ways like financial freedom. He talks about REITs. Yeah. But you actually get exclusive if you didn't know. If I believe if you're like $250,000 above, it's probably a little higher now. You actually have access to additional opportunities with that.
Well, you can also, I know there's some like startup apps now where you can it's
Fundrise?
Like Fundrise. It's like
okay.
a private, it's like a
think
private equity.
That was the one I sent to you.
It's like a private equity.
They do
like,
a lot of commercial stuff. Well, like a huge like.
It's basically, it's crowdfunding real estate.
I don't know all about it. This is not investment advice.
No, not at all.
Yeah, let's get off the REITs, all right, peeps? My bad, that's my fault.
There's so many different options. That's where I was getting to.
It's a good conversation. So this whole thing's about interest rates, right? I mean, okay, interest rates, this is where they come from. This is what we do when you go under contract. This is how we determine a rate, right? You shouldn't trust a commercial. It's not what you're always guaranteed. Another thing I want to touch on is and this isn't directly related, but we used to get all the time, okay, you're just going to sell my loan off. Like, you're not my mortgage company. You're just going to sell my loan off. You talked about it a little bit before, but I think a lot of people don't understand that. And the way I explain it is, if we did every loan and held it and collected payments from every single person, we'd be able to do 10 loans a year, maybe a little bit more than that now, but that's it. We have to stop because you only have so much liquidity and capital inside your own company that you have to shift it off.
You wouldn't be able to lend those until those other ones
Exactly.
start getting paid off.
This is why I don't even think small credit unions really don't have, because a lot of credit unions, they're going to conform to Fannie Freddie guidelines. So if they need to offload that product, they'll do it. Yeah. I mean, you'll have like your lot land loans. It's smaller, but at the end of the day, I mean, we'll put it like this. If you wanted everybody to hold your loan and you wanted to pay your bill, okay, you're never going to get a low interest rate. There's no money flowing, right? So it's buy, sell, trade, and it fluctuates, right? So, and who cares? The contract never changes. Yeah. And if you have a good mortgage planner, he should be sticking with you over time. So why would you even, it's irrelevant who you're paying your bill to. Yeah. That's my thought on it.
Yeah, and I mean that's all it is. It's
like you're gonna go to that local bank. Oh, I'm gonna pay 0.75% more, right? Because they're gonna hold my note. Okay.
I wouldn't, but
all right. Go ahead. I mean, all right. Anyway, sorry.
Yeah. It's something that I think a lot of people don't understand, or for some reason that's a big deal. I don't understand why, but that's why we have to do it. That's why we can't hold everybody's loan forever. It's just you have to free up liquidity. You only have so much capital. Somebody else has to hold it. It's just how it works. So sorry, I just wanted to cover that.
No, as long as we're listen, and I want to piggyback off of that. As long as we're doing our jobs as modern mortgage professionals, there should be no problem there. And honestly, I've never really got any kickback. Once in a blue moon, and then once I explain it to them, they're like, "Oh, well, that makes sense." And it's pretty much how it's always been. So that shows the lack of financial literacy in our industry. Mm-hmm. It's disgusting that we're not stepping up to the plate and doing more. I wanted to talk to you one more thing though on the rates. So. You know what? We'll shift into it. Shopping, right? Yeah. I'm going to shop around and I see a bunch of different interest rates. Sam, tell me how that's going on right now.
Yeah. So here's, like we said before, everybody wants the best deal. Nobody wants to lose out. Nobody wants to pay more than they have to.
Yep.
Nobody's ever going to want to do that. I'm a consumer. I don't want to do that. I will shop, when I go buy a car, I'll shop around for good prices, right? What people have to understand is when you're shopping around for interest rates, especially when you haven't even found a house yet, you're just stressing yourself out, right? Because for one, it means nothing until you get a locked loan estimate. There's no mortgage company who's bound to it, and it changes up to 20 times a day. So you're literally stressing yourself out for no reason for shopping. And like sometimes I'll have people, go back and forth and okay, I'm going to check with this company, I'm going to check with this company. That's great, but you're doing all this work for no reason because you're not under contract yet. You can't lock a rate in. There are some companies who allow you to lock ahead, but I don't think that would probably be the best idea because you got to think mortgage companies are a for-profit business. If they're doing something that everybody else isn't doing, there's got to be a cost to it somewhere, right?
Yeah, and here's the other thing too with the lock ahead. Listen, if you have a good mortgage professional, right, and we're both getting our rates from the same place, right? This bank and us, right? If we're doing our due diligence and we're monitoring the market on a daily basis, which we should be, okay, not playing Candy Crush, not sitting on our phone watching YouTube videos. Like if we're doing our jobs and what we're supposed to be doing, then we have the opportunity to lock when we get there. If you're talking about a lock ahead, I don't know. I'm seeing some things about 6-month lockout, for interest rates. I guess you can do it. I don't know the fine. There's always a catch though. Yeah. There's
a cost. It's a for-profit business.
Because
they're not
here's the
give
thing.
you anything for free.
We're basically okay. So when we lock a loan in, okay, in our place, okay, in the back end, everybody, you want to know how this works, how we hedge, right? What we're gonna do is we're gonna lock a loan in that day, right? It doesn't matter where the interest rates go up or down. We promise that to you, right? Mm-hmm. Here's the thing. We buy an insurance policy on that. If that rates go up, we have an insurance policy. If they go down, then we have a little bit more profit, right? Normally, it's never doing that. But the entire point is how is a bank that has, let's say that they have a $50 or $100 million warehouse line, how are they going to make that commitment over that long period of time? There's a catch.
Yeah.
So
they charge you for it. It's as simple as that.
Yep.
Right? They charge you for it. Okay, we'll lock you in early, but it's going to cost you.
Well, and like you just mentioned, I mean, sometimes you never know what the rates are going to do. I mean, there is the possibility that they go down.
Yeah.
I don't even know why people are like so fixated. They fixated on it that like 1/4% or 1/8% makes thousands and tens of thousands of dollars a difference in a
how much difference?
$200,000 loan, 1/4%, probably less than $20, so $20 to $25 a month.
Yeah.
And here's the thing too: if I'm only going to stay in my property for 5 years, right? And let's even say that other bank caught the market. And by the way, different rates, different days, right? So that bank could have caught the market on a better day than I did, or a worse day, right? That doesn't meet them, better. It's just indifferent, right, on that particular day. But let's say that they locked in, and let's say I was an 1/8 of a percent higher, right, over a 5-year period, less than $1,000.
Yeah.
So if it's less than $1,000, is my time and my guidance and our relationship worth it to you, or do you want to press a button with the largest decision you're ever going to make financially and emotionally, and then they just disappeared because I got my interest rate, right? So you got to figure out what you want first.
Yeah, and the bottom line is shopping is one thing, trying to get the best deal is one thing. You always are going to want to get the best deal. Who doesn't? But what you have to understand is, when you're shopping around before you even find a house you're going under contract, or you have nothing locked, you're stressing yourself out for no reason. That's why if you go get 10 pre-approvals and you get 10 pre-approvals with different interest rates and you choose to go with the lowest one, that's doing you no good at all. Because we can give a pre-approval out that says 2%. There's not a chance in hell you're going to get a 2% interest rate right now. No way. But we could do it. We're not held to it. We have wording in the pre-approval that says we're not bound to this, right? So does everybody.
Well, the best analogy too is just like, you want that 3.5? Rates are close to 5. Okay, we'll give it to you. It'll be on a 15-year note.
Yeah.
Okay, you want to pay another, a few $100s a month? Oh, you don't. Yeah. Okay, well, that's the whole point. But once again, it starts with us. It starts with us having that conversation and addressing it up front, and just letting the general consumer know, listen, this is what happens. And if you're planning as a worst case scenario, then you're going to be okay. It's the people that undercut everything and give everybody the best expectation up front, and then wonder why, that client is frustrated with them later and they don't have a good review or a long-standing relationship. And it happens a lot. It sucks.
Yeah, I mean, it's just you're going to stretch yourself out doing it. So it means nothing. I hope that through this whole podcast, we've given enough explanation as to where these rates come from, why every bank goes to the same place but isn't always the same, right? But for the most part, it's you're just stressing yourself out when you're shopping around, especially when you're not under contract yet.
You're shopping for something that's not available. And here's the thing, peeps. If you have a good mortgage professional, if he's doing a good job, this is how you know he's doing a good job, okay? He's going to give you a comprehensive report. He's going to go over everything from the short-term, the long-term cost of the loan. He's going to go over different interest rate strategies. He's going to go over purchase price, down payments, right? But the most important thing is the total cost based on what your goals are, how long you're going to be in there for. Standard, you might get some fee worksheet, PDF, right? Have fun because it's got the interest rate that you want. Exactly. Right. With no education behind it. Now, I'm not going to lie to you. If I'm going to invest X amount of time and money into something, I'm going to want to be thoroughly educated on where my money's going and how it's being allocated.
Definitely. And what I always say too is, like, I'm the type of person who pays for value, right? Like, I don't, I do like the best deal. I like shopping around and making sure I'm getting a good deal. But at the end of the day, it's like, I'm going to pay for value, right? And I feel like that's how most people are. They just don't want to admit it.
Yep.
Most people want to pay for value. They want a good experience. they just tell themselves that that's not what they want. They just want the best deal. You know what I mean?
That's why a Wagyu steak costs $220.
I love Wagyu.
Well, that's the thing.
That's
It's
so
value.
good.
There's a
Well, I mean,
difference in
you're
it.
paying
There's a
for a
quality.
service. Well, yeah. I mean, it's just like, okay, let's say that, and this has happened before. You pay $10, $15 more a month with me. Is my service worth it? Because remember, I'm going to be with you.
About the experience too.
The experience, the education, how long we're always going to come back and we're going to help you out.
Exactly. I mean, like, okay, you go and close with somebody who's $10, $15 a month cheaper, but is that person going to call you when you hit 80% in equity on your conventional loan and say, hey, it's time to call your servicer and drop off your mortgage insurance? That's free. Probably not. Would we do it? We do it all the time.
Yeah, for sure.
So, okay, are we sometimes competitive? Yes, but bottom line is you pay for value, and a lot of people don't understand that or don't think that they do, but that's what it is at the end of the day. So don't stress yourself out by shopping. Yeah. But that's going to conclude this episode. I think it was a really, really value-packed one. There was tons of information.
Loved it.
Evan, thanks for giving
my favorite by far.
I mean, I definitely learned a lot. I think if any other agents are listening, they can learn a ton.
Yeah.
Same for the consumer.
Yep, for sure.
Kind of gives them different insight. But
all right, guys.
Till next
Thanks
episode.
for tuning in.
Till next week.